Howdy, Jacob here. Today we're looking at Arch Resources. This is after we looked at Alpha Metallurgical. Again, keep in mind everything I say will be of my opinion. Do what you want with it. I'm just going to go through what I've read from quarterly reports, 10K, 10Qs, and pull that information. You can do, again, do what you want with it. This isn't an end all be all. You're still going to have to do more analysis if it comes out to a price that still looks like a buy. So just keep that in mind. But for now, I think I'm going to get to the numbers, remind everyone about the business, and then we'll get to the points that I took from the most recent reports. So it's in the oil, gas, consumable fuels industry. It's in the coal industry, really. They also are in the met coal industry. 2.2 billion market cap, less enterprise value, also good. Growth, again, very high in 2021, 2022, dampened revenue in 2023 as demand slowed a little bit, but their capital allocation is going a lot heavier towards dividends. The balance sheet shows 288 million in cash, 33 million short-term investments, 35 million short-term debt, 105 million long-term debt. So again, much more cash on hand than debt. Not terribly concerned by that. Free cash flow production in the last couple of years, fantastic, with most of their money going towards dividend, a little bit going towards share repurchases, and debt pay down as well. So let's go over some of the things I took from the quarterly report, 10K and such. So they're expected to merge with Consol Energy by the end of 25 Q1 in an all-stock merger with a new company, Core Natural Resources, will be made up of approximately 45% Arch, 55% Consol. So again, this is something that you'd want to look into. You'd want to look into Consol Energy. They're a similar business. And so you'd want to see what the valuation is for that and see if it still makes sense for you. And beyond that, again, this isn't just an end all be all video, so you're going to have to do more research beyond this. Three things the CEO cares about a great deal are margins, cash generation, returning money to shareholders. The returning money to shareholders was obviously a mix of dividend and share repurchases, which I'm fine with. And so I found it appreciative that they pointed out the CEO's comments and what they were looking for, because I don't mind these. I think these are good things to care about. Obviously, the biggest thing that I would be focusing on would be free cash flow, but margins help with that. Cash generation absolutely helps with that. Returning money to shareholders, given the growth of the coal industry, I think that that's a pretty promising thing to look forward to. They stated with this strategic decision to bolster our cash balance, we believe we have effectively positioned the company to continue the evolution towards a heavier share repurchase model and are now ready to pursue more opportunistic share repurchases in the event of a market pullback. That's exactly what I want to hear. We'll see whether they're actually, actions speak louder than words, but they're basically saying if the market were to pull back, if this company's price were to drop 50%, we have capital on hand to buy back a bunch of shares. And they're going to their goal is to buy back cheap shares. So that's why they have a dividend right now, which might be reduced, but I think it's in a fine place given that its payout is pretty reasonable. But their share repurchases are or at least that's what the CEO is stating. They're going to be strategic about it and buy back cheap shares, not just shares at any price, but cheap shares. So we're also going to look to the right after this to see. I pulled in their by quarter, what they've purchased and at what price, to see if that's actually following through. But this was more recent, so we'll see. The market update and looking ahead portions of their quarterly reports, their quarterly results, are not as specific as I would like, but I do appreciate the extra details. This is just pointing out in their quarterly reports. They do point out a market update, which they give a general update of the market, of the coal industry in general, and then they have looking ahead to see where they think they're going, both in the industry as well as the business itself. And I appreciate it. It's not super specific, but I do appreciate it still. They are the second largest coal producer in the USA by total production with 13.2% share, bigger than AMR on a whole coal producer portion. Consol is 4.1% share based on 2022. Again, U.S. Energy Information Administration. This is total coal production. So keep that in mind. It's not just metallurgical. This is thermal and metallurgical. Basic background, China accounts for over 50% of the total world production of coal. U.S. coal production has decreased 50% in the past decade as demand has continued to decline. U.S. coal production, according to the EIA, again, that's the Energy Information Administration, has over 350 billion short tons of recoverable coal reserves, able to supply at current demand for the next 500 years. So again, it isn't anything by itself, but just makes me feel better that looking at the numbers, the business is likely going to keep things going with their reserves, and unless there's any big problems with it with their mines, they should have no problem with keeping up with supply or keeping up with the demand. The question is just, will the demand still be declining as much as it is uh, globally, since a lot of their sales are still going outside the United States. Met coal was sold to 5 North American customers and 34 overseas. Their customers are responsible for transportation domestically, but overseas responsibility usually ends at the port. So, for example, what I understood from this is that West Virginia is the majority of where their met coal is coming from, and Colorado, and I believe somewhere else, is their thermal coal. And so, if let's say the thermal coal from Colorado, they have a client going to Japan or Australia, then they're liable from it in the plant and then transportation to the seaport in California, wherever it is. And then it'll be on the client or your customer once it hits that seaport to go from seaport to Australia, wherever they are, and then Australia seaport to their manufacturing place. And so their factory. And so just keep that in mind. I think that detail was very important and something I didn't necessarily see specifically for alpha metallurgical. And so I'll definitely have to do more deeper dives on that to see where the responsibility is kind of held there. But I definitely found that interesting. 88% of coal volume was sold as thermal products, with only 12% as metallurgical. However, because metallurgical has significantly higher value and price, the portion of revenue was actually 60% metallurgical, 40% thermal, and other. So competition is both other companies in the coal industry as well as other energy sources. So again, that's why the thermal energy is kind of in a spot that's troublesome, because they're fighting against just how you're going to heat a house, natural gas, solar, nuclear, whatever. And so their competition is a lot greater than just met coal, because met coal needs to be produced to create this coking or caulking, whatever it is, to make steel. And so I think that there is a little bit of difference in competition between your arch and your AMR. So coal is a commodity. The volatility of prices, there's a high volatility of prices. That's just to say, that's why the last 2 years demand was crazy, revenue was up like crazy. Makes sense. Last year demand's down a little bit, commodity price down a little bit. Bam. 15% of the total revenue was from 3 clients, 39% from top 10. So I do appreciate that they're a bit more diversified from a total revenue standpoint by client compared to Arch or compared to AMR. But 15% for top 3 clients is actually pretty reasonable. More than a decade of expected coal in almost all locations. Again, this is a 7-year analysis, so that's just to make me feel good about, as long as demand sticks pretty consistent with the compound annual growth rate globally, they should be doing all right, and I should feel comfortable with the 7-year analysis I have. As for capital allocation, 2% was actually divestitures, so not acquisition, but selling off of acquisitions in property and plant. 45% to the dividend, 19% share purchases, 36% pay down. Again, their debt is almost nothing, and so that capital allocation will be able to go to dividend, share purchases, acquisition, reinvestment, whatever. That'll create more opportunity for them. And then when it comes to debt, they have 36 mil due in 24 and 106 mil due in 2025, which in relation to free cash flow is very little, as their production of free cash flow in the most recent year was over 400 million. So I think they're just going to pay that off, be debt free, or pretty much debt free. And so let's go with our new assumptions. So I dampen the revenue slightly because, again, a lot more of their revenue comes from thermal energy and heating houses, heating energy companies. And I think that demand is going to be a bit more dampened. And the margins are a little bit down due to that. Share repurchases, they're not buying back as many shares because their dividends as high as it is. And so for me right now, I think it has to fall 28% to get to the term I'm looking for here. I think AMR is the better deal right now, but I think both businesses are great, and I will definitely have to do more research in this coal industry, especially the metallurgical coal industry. Hope you enjoy the video and have a great rest of your day. Thanks.